What do you think of Wall Street incomes these days?
Excessive.
I was getting a lot of anonymous emails from bankers saying, you can't quote me, but I'm really concerned.
The regulators didn't do their job. They had the power to do every case that I made when I was state attorney general. They just didn't want to.
Lehman Brothers, one of the most venerable and biggest investment banks, was forced to declare itself bankrupt. Another, Merrill Lynch, was forced to sell itself. Today, crisis talks are underway.
World financial markets are way down today following dramatic developments.
In September 2008, the bankruptcy of the U.S. investment bank Lehman Brothers and the collapse of the world's largest insurance company, AIG, triggered a global financial crisis.
Fears gripped markets overnight with Asian stocks slammed.
Stocks fell off a cliff, the largest single-point drop in history.
Share prices continued to tumble in the aftermath of the Lehman collapse.
The result was a global recession, which cost the world tens of trillions of dollars, rendered 30 million people unemployed, and doubled the national debt of the United States. This crisis was not an accident. It was caused by an out-of-control industry. Since the 1980s, the rise of the U.S. financial sector has led to a series of increasingly severe financial crises. Each crisis has caused more damage, while the industry has made more and more money. After the Great Depression, the United States had 40 years of economic growth without a single financial crisis. The financial industry was tightly regulated. Most regular banks were local businesses, and they were prohibited from speculating with depositors' savings. Investment banks, which handled stock and bond trading, were small private partnerships. In the 1980s, the financial industry exploded. The investment banks went public, giving them huge amounts of stockholder money. People on Wall Street started getting rich.
The highest order of business before the nation is to restore our economic prosperity.
In 1981, President Ronald Reagan chose as Treasury Secretary the CEO of the investment bank Merrill Lynch, Donald Regan.
Wall Street and the president do see eye to eye. I've talked to many leaders of Wall Street. They all say we're behind the president 100%.
The Reagan administration, supported by economists and financial lobbyists, started a 30-year period of financial deregulation. In 1982, the Reagan administration deregulated savings and loan companies, allowing them to make risky investments with their depositors' money. By the end of the decade, hundreds of savings and loan companies had failed. This crisis cost taxpayers $124 billion and cost many people their life savings. By the late 1990s, the financial sector had consolidated into a few gigantic firms, each of them so large that their failure could threaten the whole system. And the Clinton administration helped them grow even larger. In 1998, Citicorp and Travelers merged to form Citigroup, the largest financial services company in the world. The merger violated the Glass-Steagall Act, a law passed after the Great Depression, which prevented banks with consumer deposits from engaging in risky investment banking activities. The next crisis came at the end of the 90s. The investment banks fueled a massive bubble in internet stocks, which was followed by a crash in 2001 that caused $5 trillion in investment losses. The Securities and Exchange Commission, the federal agency which had been created during the Depression to regulate investment banking, had done nothing. Eliot Spitzer's investigation revealed that the investment banks had promoted internet companies they knew would fail. Stock analysts were being paid based on how much business they brought in, and what they said publicly was quite different from what they said privately.
Infospace, given the highest possible rating, dismissed by an analyst as a piece of junk. Excite, also highly rated, called such a piece of crap.
The defense that was proffered by many of the investment banks was not, you're wrong. It was, everybody's doing it and everybody knows it's going on and therefore nobody should rely on these analysts anyway.
Between 1998 and 2003, Fannie Mae overstated its earnings by more than $10 billion.
These accounting standards are highly complex and require determinations over which experts often disagree.
CEO Franklin Raines, who used to be President Clinton's budget director, received over $52 million in bonuses.
The financial services industry seems to have a level of criminality that is, somewhat distinctive. When was the last time that Cisco or Intel or Google or Apple or IBM,
I totally agree with you about high-tech versus financial services, but high-tech...
So how come?
High-tech is a fundamentally creative business where the value generation and the income derives from actually creating something new and different.
Beginning in the 1990s, deregulation and advances in technology led to an explosion of complex financial products called derivatives. Economists and bankers claimed they made markets safer, but instead, they made them unstable. Using derivatives, bankers could gamble on virtually anything. They could bet on the rise or fall of oil prices, the bankruptcy of a company, even the weather. By the late 1990s, derivatives were a $50 trillion unregulated market.
So help me God. So help me God.
By the time George W. Bush took office in 2001, the U.S. financial sector was vastly more profitable, concentrated, and powerful than ever before. Dominating this industry were 5 investment banks, 2 financial conglomerates, 3 securities insurance companies, and 3 rating agencies. And linking them all together was the securitization food chain, a new system which connected trillions of dollars in mortgages and other loans with investors all over the world. In the old system, when a homeowner paid their mortgage every month, the money went to their local lender. And since mortgages took decades to repay, lenders were careful. In the new system, lenders sold the mortgages to investment banks. The investment banks combined thousands of mortgages and other loans, including car loans, student loans, and credit card debt, to create complex derivatives called collateralized debt obligations, or CDOs. The investment banks then sold the CDOs to investors. Now, when homeowners paid their mortgages, the money went to investors all over the world. The investment banks paid rating agencies to evaluate the CDOs, and many of them were given a AAA rating, which is the highest possible investment grade. This made CDOs popular with retirement funds, which could only purchase highly rated securities. This system was a ticking time bomb. Lenders didn't care anymore about whether a borrower could repay, so they started making riskier loans. The investment banks didn't care either. The more CDOs they sold, the higher their profits. And the rating agencies, which were paid by the investment banks, had no liability if their ratings of CDOs proved wrong.
You weren't going to be on the hook, and there weren't regulatory constraints. So it was a green light to just pump out more and more and more loans.
Between 2000 and 2003, the number of mortgage loans made each year nearly quadrupled. In the 2000s, there was a huge increase in the riskiest loans, called subprime. But when thousands of subprime loans were combined to create CDOs, many of them still received AAA ratings.
So did these guys know that they were doing something dangerous?
I think they did.
Suddenly, hundreds of billions of dollars a year were flowing through the securitization chain. Since anyone could get a mortgage, home purchases and housing prices skyrocketed. The result was the biggest financial bubble in history.
From 1996 until 2006, real home prices effectively doubled.
On Wall Street, annual cash bonuses spiked. Traders and CEOs became enormously wealthy during the bubble. Lehman Brothers was a top underwriter of subprime lending. and their CEO, Richard Fuld, took home $485 million. During the bubble, the investment banks were borrowing heavily to buy more loans and create more CDOs. The ratio between borrowed money and the bank's own money was called leverage. The more the banks borrowed, the higher their leverage. There was another ticking time bomb in the financial system. AIG, the world's largest insurance company, was selling huge quantities of derivatives called credit default swaps. For investors who owned CDOs, credit default swaps worked like an insurance policy. An investor who purchased a credit default swap paid AIG a quarterly premium. If the CDO went bad, AIG promised to pay the investor for their losses. But unlike regular insurance, speculators could also buy credit default swaps from AIG in order to bet against CDOs they didn't own. Since credit default swaps were unregulated, AIG didn't have to put aside any money to cover potential losses. Instead, AIG paid its employees huge cash bonuses as soon as contracts were signed. But if the CDOs later went bad, AIG would be on the hook.
People were essentially being rewarded for taking massive risks in good times that generate short-term revenues and profits and therefore bonuses. But that's going to lead to the firm to be bankrupt over time. That's a totally distorted system of compensation.
By 2008, home foreclosures were skyrocketing, and the securitization food chain imploded. Lenders could no longer sell their loans to the investment banks, and as the loans went bad, dozens of lenders failed. The market for CDOs collapsed, leaving the investment banks holding hundreds of billions of dollars in loans, CDOs, and real estate they couldn't sell.
We're going to keep growing, okay? And obviously, I'll say it, if you're growing, you're not in recession, right? I mean, we all know that.
In a matter of days, one of the pillars of Wall Street...
In March of 2008, the investment bank Bear Stearns ran out of cash and was acquired for $2 a share by J.P. Morgan. On September 7, 2008, Henry Paulson announced the federal takeover of Fannie Mae and Freddie Mac, two giant mortgage lenders on the brink of collapse.
Nothing about our actions today in any way reflects a changed view of the housing correction or the strength of other U.S. financial institutions.
2 days later, Lehman Brothers announced record losses of $3.2 billion, and its stock collapsed. By Friday, September 12th, Lehman Brothers had run out of cash, and the entire investment banking industry was sinking fast. The stability of the global financial system was in jeopardy. That weekend, Henry Paulson and Timothy Geithner, president of the New York Federal Reserve, called an emergency meeting with the CEOs of the major banks in an effort to rescue Lehman. But Lehman wasn't alone. Merrill Lynch, another major investment bank, was also on the brink of failure. And that Sunday, it was acquired by Bank of America. The only bank interested in buying Lehman was the British firm Barclays. But British regulators demanded a financial guarantee from the US government. Paulson refused. That same week, AIG owed $13 billion to holders of credit default swaps, and it didn't have the money. American families borrowed to finance their homes, their cars, their health care, and their children's educations.
People in the bottom 90% lost ground between 1980 and 2007. It all went to the top 1%.
For the first time in history, average Americans have less education and are less prosperous than their parents.
The era of greed and irresponsibility on Wall Street and in Washington has led us to a financial crisis as serious as any that we faced since the Great Depression.